Stock markets all over the world have rallied over the last 1 week on expectations that the US Federal Reserve will not raise interest rates in the month of December in its policy meeting. This dovishness on the part of the markets is signified by the Fed funds rate, the Fed funds futures rate, which seems to be showing that the probability of a US hike in interest rates in the month of December is as low as 16%. On the other hand, you have the central bankers who seem to be taking a rather hawkish view of monetary policy. Janet Yellen has clearly indicated that there is a very good chance of interest rates going up in the month of December. And naturally, if that fails to materialize, then her credibility would be at stake. But from the market's point of view, there seems to be some sort of a divergence between what the markets are anticipating and what the central bankers seem to be signifying. The very hawkish view of the central bankers is at crossroads with the dovish view of the markets. So therefore, in such a scenario, when there is such a big divergence between what the markets are expecting and what the Federal Reserve and central bankers seem to be wanting to deliver, there is bound to be a great amount of volatility, and this could translate into a sudden fall in stock markets. Why this could happen? Because the Federal Reserve, it is really inclined to raise interest rates in the month of December. It may start signifying much in advance that the rate hike is round the corner. And when the markets are not expecting a hike in interest rates, just look at the federal funds rate and futures rate and what it is signifying, a less than 16% probability of a hike in interest rates in the month of December. And naturally is bound to catch the stock markets by surprise. And I have been time and again saying that this indecision on the part of the Federal Reserve, more than the slowdown in China, is bound to roil global stock markets. People keep saying that China is going to be the root cause of the next global recession. True, but do not forget the fact that most countries in the world are net importers from China and not net exporters, which means to say they have the whatever is the reduction in prices that takes place, the deflation in China is going to benefit the companies which import from China. What is going to stand out is the fact that the US Federal Reserve doesn't know which way to go. What it reads, if let us say from now until December, the jobs report shows a significantly strengthening job market and a stronger American economy, that is bound to put pressure on the US Federal Reserve to hike interest rates. Now, central bankers do have precedents. For example, do not forget the fact that the ECB in 2008 was too early to raise interest rates, just 3 months before Lehman Brothers went into bankruptcy. Also, the Federal Reserve has to make sure that it doesn't lose its credibility by not hiking interest rates in December, as Janet Yellen seems to have clearly indicated that the rate rise is round the corner. So this particular aspect is going to add to further uncertainty in the markets, and I personally feel that the stock market rally that you've seen over the last 1 week is not going to sustain very long. Just a few more days and you should see some great amount of uncertainty creep into the markets, and you should see a huge downfall around the corner. And as I have clearly mentioned, that it is the uncertainty of the Fed more than slowdown in China which is going to impact adversely the global stock markets in this particular point of time. So be prepared accordingly and position your investments in that sphere from this perspective. Take care. Happy investing. Bye bye.